Okay, welcome everybody. Thank you for joining Rhonda and I. Tonight we're going to do a Zoom webinar on getting your credit ready to buy a home. So we're happy you're here with us. Rhonda and I hope that you get some good information out of the webinar tonight. We're going to start with introductions. So I'm Nikki Hubbard. I'm a loan officer with VIP Mortgage. Just reached 5 years at VIP. I've been in the industry about 13 years now. I love to help first-time home buyers, and I'm located on the Big Island on the east side. Um, and so one of the things for first-time home buyers is, knowing about your credit and getting your credit ready. So that is why when I met Rhonda and she said she's willing to do webinars with me, I was really stoked. Rhonda and I met through a networking group that we're both members of, and I started referring some of my clients over to her for her services to help them with their credit. And she's very knowledgeable because of her background, which she's going to tell you about a little bit in a minute, and very helpful and very customer focused as well. So she loves to help people get to the end goal, which is into homes, or getting your finances in order, and your credit is a big piece of that. So I'm basically just going to be the Zoom moderator here. After this, I'm really going to let Rhonda introduce herself. I'll do a couple slides, but mostly we're going to let Rhonda tell us about credit because she is the expert. Well, what is our next slide? Oh no, wait, don't go to that slide. You have to introduce yourself first.
All right. Aloha, everyone. I'm Rhonda Alexander Moncras, and I'm the owner of Kupa'a Consulting Services. I'm a credit coach. I'm located on the island of Maui. I was born and raised on the island of Oahu. And I have sisters that live on the Big Island. And so I provide credit coaching services to Hawaii residents statewide. I was a former HUD housing counselor. And while serving in that role and helping quite a bit of local residents, I realized that the one roadblock that was a bit of a challenge for people was credit. And so I decided to jump into this space of helping them with this particular roadblock. And I wanted to be a solution maker for Hawaii's housing crisis. So that's why I'm here. That's how I connected with Niki. Love working with first-time home buyers, but essentially anyone who wants to improve their credit to be able to reach their family goals, their financial goals, anything it is that you want to be able to achieve. So that's my mission, and that's what I help people with.
Beautiful. Okay, so for some foundational why, we're going to show you minimum credit score requirements for some of the loan programs that you might use if you were to purchase a home. And so you'll see a variety of scores. VA is a loan program for veterans. They don't have a minimum credit score requirement. FHA is another government guaranteed loan. They will allow you to finance up a loan with them or they will guarantee a loan with them as low as 580 for your credit score. And USDA and conventional loans, you'll want to be at a 620 to use those programs for financing. And for perspective, credit score is going to range from 400 something to 850 somewhere, depending what model you're looking at, but that's a big range. So these scores are on the lower end, but why, if we have something wrong with our credit, we don't want to keep just settle. If we can do things to get credit better, our credit is a big piece of our loan qualification. So we have to see our ability to repay, but also what our credit score is. It drives the qualification. So some of the programs will have stricter debt to income ratios if you have lower credit, and all of the programs will have a cost associated with your rate for having lower credit. So we're going to go on to the next slide just to see that in an FHA example. So if you can get an FHA loan, in this example, you get a rate at 7.125, which you'll see is higher than other rates. And you'll also pay more for that rate. The lender will charge you points, almost 3 points for that loan because your credit is low. And so it's going to cost you thousands of dollars, as you'll see here in the slide. It says $14,000. So if you could do something to get your score up to 640, that's like $6,000 less that you'll pay, and you'll have a slightly lower interest rate. And then if you look in the example on the side there, you can see maybe you could do something to get your score up even maybe 660, 680, and then you're going to have more savings just the higher your credit is. So this is really the why. Why should we care about fixing our credit if we can have a credit score as low as 580? Well, it's because it costs you money and it makes it harder to get the loan. And so if we have time up front and we can work on credit, let's work on it. And that's what Rhonda and I wanted to share tonight. So I'm gonna turn it over to Rhonda. She's gonna tell you how to get your score to go up.
Yeah. And Nikki, is it true that when people, if there's more than one person that applies for a home loan, is it whoever has the highest score that's used for the loan? Or like in this example, if this was 2 applicants and one came in with a score of 599 across the board, and the other applicant came in with what we see are in the 600s.
Right.
So yeah.
In mortgage qualification, if you have multiple borrowers, we take the middle score for qualifying, and the lower middle score is the qualifying score, and that's the score your rate is priced off of. So it doesn't matter if you have someone sign on with you that has good credit, because if your score is worse than theirs, your score is going to be the one that the loan is qualified off of. So we want to get scores up.
Yeah. Yeah. Great. Yeah. So definitely whoever it is that's going to be on the loan with you, or that you're considering to have on the loan with you, whether it's auntie, uncle, mother, father, brother, child, or so forth, the scores matter for everyone that's going to be on the loan, and you should be aware of that. So as I move on to the next slide, if all of you could put in the chat, 1, do you check your credit? Do you know where your credit is at now? And what do you use to check your credit? So is it Credit Karma? Is it your bank app? Just kind of put it in there, and then we'll just kind of check it and see what everyone says about it. Okay, so while you guys are putting those things in there, so, when we looked at the scores that Nikki was talking about earlier with the 2 applicants, one at 599, one at 664, what are the things that make up the differences, in the score? And here's just a list of things that could impact your credit. So it could be late payments, bankruptcies, car repossessions, which happened during COVID. There could be judgments that you have on charge-off or collection accounts. And those actual charge-off and collection accounts. So that's when you have a past due balance for an account that you didn't pay off, or that maybe you might have had a joint loan or a joint credit card with someone that you're not with anymore. Who's responsible for it? Well, if you're joint on the account, you're responsible for it. So those items, foreclosures, and then also we have people who pay a lot of things in cash. Maybe they were raised to pay off things that way, or they were a little cautious with their spending habits and patterns until they got to the point where they want to buy a house and they don't really have any credit. So what do they do? So we're going to cover all these things, and we're going to show you how you can build credit no matter where you are, and positive steps that you can take to qualify. So 79% of credit reports have errors on them. And of that, over half of them are corrected. So this is part of the motivation behind, 1, if you don't check your credit, check it. There are a lot of free apps that are out there that allow you to be able to do that. At some point, you want to get to the place where you're looking at a 3 bureau report. Okay, so there's TransUnion, Experian, and Equifax that provide you a credit score. And that's what someone like Nikki is going to be pulling. She's going to be pulling a 3-bureau report. So Credit Karma is 2-bureau. Credit Karma is TransUnion and Equifax. If you log in and you get a credit report from Experian, Experian has one just for Experian, but they also have a 3-bureau report. Then there's a variety of other credit monitoring systems that you could get. There's myfico.com. So myfico is maybe about $40 to $60 a month, depending upon the frequency with which you want to pull a credit report. And then with Kupa'a, we have one that's $24.95 a month. You can start off with $1 to get access to your 3-bureau credit report for a 7-day trial window. And then at the end of the 7 days, if you decide to continue with the subscription, then it would be $24.95 a month. But that's an option, you know, for you as well. So let's take a look in the chat. Let's see what everybody's using. So we got Credit Karma. Yep, that's a very common one. Bank offers a credit check, bank app, Identity IQ, okay. Credit card app, Equifax. Check it occasionally on Experian, credit card app. Let's see. Credit was low in 700. Okay, Ashley, we'll talk about ways to build your credit. And some people don't check their credit. So it's totally okay. You are where you are. But today, I want you, after this workshop, go check your credit. Go figure out which one you're most comfortable with. Credit Karma is always a great way to start because it's free, it's easy, it's online. But just keep in mind that's 2 bureaus. So not only do you want to see the score, but you want to see the account details and make sure the account details are accurate. So what makes up the calculation for your credit score? Well, here's what it is. Okay, so 35% of your score is calculated based upon payment history. So whether you pay your bills on time or not. 30% is based upon the amounts owed. So the amounts owed is when you have credit cards. If you have a $1,000 credit limit, do you max out your card? And you only pay the minimum payment. So your credit utilization may be high. And if your credit utilization is over 30%, your credit score is going to drop. So that's the amounts owed piece. So the payment history, 35%, and the amounts owed, 30%, that's 65% of your score. So it's totally in your control to be able to manage your credit score and to actually boost your score if you can make adjustments to these behaviors, are aware of how you have control over these things, to help improve your score overall. And that's some of the things that we're going to teach you today. And we also provide that additional teaching and coaching as part of Kupa'a services. So the other 3 factors that calculate into your credit score is credit mix. So credit mix is 10%. Credit mix is, you know, do you just have one loan on your credit report? Is that it? If you just have one loan, then your score is going to be low. So it's always good to have a good credit mix of, you know, 2 credit cards and 2 loans on there. Next is credit history. So how long have you had credit? You know, has it been 1 year, less than a year, 6 years, 10 years, 15 years? And then new credit. So when you apply for new credit, is there anybody here who, when you go to a store and you get up to the cashier and the cashier goes, oh, you know, would you like to sign up for a credit card today because you'll get 20% off? And it's very appealing. So, right, I used to do that a lot. I used to sign up for everything. Yes, give it to me, 20% off. I'm going to get, yeah, I got such a deal. But I started to have bad habits because I started to use and buy more things than I needed. And I had to really learn how to control my urges, my temptations, and my behaviors. And new credit impacts, you know, your total approval process for a loan once you get to that point in. When we get to that section, I'll have Nikki speak about that a little bit more. So let's dive into each section. amounts owed. So this is what we call credit utilization. And you see here on the left side of the screen, it has a 30 and a 10%. So anytime your credit goes, your credit that you're using on your credit card and the balance owed that's reported to the bureaus once a month, anytime it's over 30%, your credit score will go down. So anytime you get it below 30%, your credit score will go up. The most ideal spot to be in, and especially for those of you who are seeking to be a homeowner, is to keep your credit utilization at 10% or lower. So you'll hear, people say, oh, 7% is the best spot, 5% is the best spot, 2% is the best spot. 10% or lower, you're good. So if you have $1,000 credit card and 30% is going to be $300 and 10% is going to be $100. So that's the balance that you want to report at the statement end date. So the other thing I want to highlight is the statement end date versus the due date. So a lot of clients that come into Kupa'a services were not aware that the statement end date was such an important date. So this is the date when you log into your bank and you look at your credit card statement, it's going to say, oh, this statement is for, February 1st to February 28th. The statement end date is February 28th. So that's the date that account reports to the credit bureaus. All of your accounts are going to have different statement end dates. So you, as a consumer, need to be aware of the statement end date for every single account, when it's going to report, and you set up a little tickler system to remind you to make that payment 3 days prior so that the payment clears by the statement end date when it reports. So here's some examples here. Okay, so I'm going to start with this bottom one on Target. So this is from someone's credit report. They had a $400 credit limit. They had a balance that reported of 307, and they're at 77% credit utilization. So this person has all three of these accounts on their credit report. So because they have three accounts that are reporting at 77% credit utilization, 101% credit utilization, and 88% credit utilization, their credit score went down close to 100 points because of this. And just by paying it off, your score can go up anywhere from 50 to 100 points. So it's pretty significant. But just know that if you have a month that you got to use your credit, because you're stuck, something happened, and your score goes down, it's okay. Because if you're going to pay it off the next month or 2 months later, your score will go back up. But when you're buying a house, you have to be extra cautious with it because if Niki's pulling your score next month to qualify you for the loan, then you want to make sure these credit utilization is all under 10%. And you want to make sure that you have the funds and that you're on top of the statement end dates, and that you do make those payments on time. Niki, what do you have to say about this?
This is a big one. It's so helpful to know when to pay it by the statement end date. A lot of people, I paid it on time, I paid it off on time, but they don't realize that it's going to report a different balance than because of the reporting cycle to the credit bureaus. So really having the habit, like Rhonda said, to keep your utilization under just under that 30% as a habit. And then if you plan to buy a house, you can drop it down a little more if you need to, but paying attention to your utilization, it's so important, and doing it well before you're ready to have your credit pulled for a mortgage, so that you don't have to have it pulled on the day that it happens to be lower because of the utilization. So yeah, Rhonda did that. This is a fantastic and very important piece.
Yep. So this is a big one. So after the workshop, you guys are going to go pull your credit, and then you're going to go look at your credit utilization. And what I want you to do is get into the habit on a monthly basis. Always check your credit utilization and see where you're at, just so you start getting this habit of calculating it, understanding it, knowing when you made the payments on time and when you didn't make it on time. So when I started to pay attention to my credit utilization, I would pay down my credit card But the three, in the 3 days, I used it again before the statement end date reported. So that's the other thing, is you got to be careful within that window of the new charges that come in. So I had 3 credit cards. I had one that I used all the time. Now I spread it amongst the 3 credit cards. That's a strategy that I chose to do. And so, because when I was trying to rack up those miles, right, I have a rewards card. So I was trying to rack up those miles. I was using it for regular spending stuff that I knew I was going to pay off. But what happened was my balance was reporting higher than the 30%. So my score dropped. So just be aware of all these little things. Awareness is key. Okay, so next is payment history. So payment history means whenever you have a late payment, one late payment, whatever the reason was that you was late, it doesn't matter. A recent late payment will drop your score 100 points. It's significant. So in this case, this is from a credit report. Typically what you'll see, and this is why I want you to log in and look at your credit report, because you want to be able to look at the payment history and see what are my different credit cards and loans reporting to the bureaus. Are they reporting that I was late? Did I know they were reporting that I was late? Was I late? I don't know that I was late. I think it's wrong. So if it's wrong, then that's how you can dispute it. I think this is inaccurate. I want you to show proof that I was late, because if not, then update it to positive. And you as a consumer have that right based upon the FECRA laws to be able to do that. So in this case, you can see that TransUnion is reporting late April, March, and February. So is Experian. But Equifax is reporting March, February, and then January. So when I look at this, I'm like, okay, something's wrong, because it's supposed to be the same across all 3 bureaus. So that already, to me, highlights that there's a potential inaccuracy in how it's being reported. And that would be an opportunity to ask the creditor through the bureaus to show proof that this is reporting accurately. And if it's not, then update to positive. Or if it's a closed account, then delete the whole account from my credit report. I don't want it counting in any way. So if you have these late payments can be updated to positive, and late payments can also be, late payment accounts can also be deleted from your credit report. So when we look at payment history, Nikki talked earlier about, your credit score can go up to 850. So if you look at 30% of your credit score, that's 298 points. That's a significant amount. So what about this one, Nikki?
Okay, let me just say that late are a challenge if you need mortgage financing. So anyone who has a mortgage, if you ever have a mortgage late, that is just, you cannot do any financing for a year at least, just period. No mortgage lates in the last 12 months, not allowed. But if you have any lates and you are looking to finance your first purchase with USDA or FHA, you're only allowed 1 late in the last 12 months. So even if you just accidentally forgot to pay your credit card and it reported late, you can only have 1 free chance. Like, that's it. This looks like 3 lates in a row. If it just so happened that was in the last 12 months, you can't do anything. If you have owed late on any loan, they're going to ask you to provide a letter of explanation. The letter has to show that it was something out of your control and that it won't happen again. So if you have a lot of lates in the same period of time, hopefully there was some reason like that you didn't really have control over, so you can explain it away. Otherwise, they're not going to accept your explanation that you're credit worthy, and they could choose to not give you the loan, and that would be just terrible. So lates are something you definitely want to avoid and address if you have them. And Rhonda, like she pointed out, has with a very close attention to detail, a potential way to remove them if they're inaccurate. So
Yeah.
it's great that she knows that.
Yeah, so if you have late on your credit history, when you go and check your reports, at least you know. Now you know, and now you can do something about it. Don't let it prevent you from taking action. And don't let it prevent you from starting your journey to be a home buyer. You can be a home buyer. You just have to know where you are and where you need to be, and then start taking those steps towards either cleaning up your credit, shifting some of your funds to down payment savings, all of these different things that Niki and her team puts a list together of things that you need to do to be able to become that homeowner. So next is 25% is split into the length of credit history and credit mix. So this is an actual example of a client that came in. So it was a couple that came in to buy a home. On the left was his starting scores, 470, 475, and 580. He did not need credit repair services from me because he didn't have any accounts reporting. He was a cash spender. He had one credit card account as an authorized user. So I gave him the list of how to build credit and what things to do to build credit, which you're going to get that and you can screenshot it when we get there. And within 6 months' time of him following this list, he got his first credit card. He was approved for $200 limit because he had no history. You know, now 6 months later, that card is at 5,800. And look at his scores. His scores went up to 688, 672, and 673. And the last month, which that's not the most recent scores, the last month, one of the scores crossed over into the 700s. And all he did was he opened up a Capital One account and he put one thing on there, Netflix, $20 a month. And he set up auto pay. And that's what I told him to do. And he goes, well, can I use it for anything else? I said, well, as long as you don't have high credit utilization, but if you can't remember and you can't control yourself, just put that one thing on it. Don't use it for anything else until you get, used to and more with using, right, the credit cards in that way. Then he signed up for a savings loan. So a savings loan is something where you put money away. It reports to all three bureaus as if you're paying a loan, but actually it's going into a savings account and then you get the money back at the end of the period. Just those two things is what he did. And then the third thing I would add that you can do is to get someone to add you as an authorized user, onto an account, and that will help you as well to boost your score. Somebody who has excellent payment history, excellent credit utilization, and someone who has, the length. So for example, my son turned 18 last year, I think. And so him and his cousin were my guinea pigs, and I said, okay, we're going to practice building credit with young adults. So I gave them the same outline of how to build credit. He applied for Capital One, he applied for self, and used his own money to be able to do those two things. And then we added him on as an authorized user to our credit card. You can add like up to 20 people onto your credit card as an authorized user. Did not give him a credit card because you don't need to give someone your credit card when you add them on as an authorized user. They can just take your history for their credit report. So our scores are in the 800s. Within 6 months of him doing this, his score was at 850. And, there was monthly follow-ups because he was 18, to make sure he understood everything and the behaviors that he should have. But it allowed him and it opened his eyes because then he could do what he wanted to do, which was to get a car loan. And so he qualified for a car loan and was able to get that so he has transportation to go to and from work. So these types of things, work and it can happen. Anything here, Niki?
I love the authorized user trick. I would say that if that's definitely go for the credit mix. And Rhonda's suggestions are spot on. If you only have an authorized user card, the lenders will notice that. And in some programs, particularly the government loans like USDA and FHA, they will, if that we're the only borrower, they don't have enough credit history to qualify. So you have to have a mix of credit for most of the loans. And it does help your score. So it's a good idea.
Yeah. And that kind of reminds me when I get couples that come in and one person is the owner of all the credit, the other person is the authorized user. My, initial recommendation is, okay, you both need to create credit on your own independently. You got to have your own credit cards. You got to have your own credit history. You got to have your own loans. And, again, following those steps is how they can achieve that. Okay, so next is increase. Increase is a small percentage of your credit score. So this is when you apply for new credit, right? So when we go back to when you go into a store and they're always offering, oh, do you want our store credit card because you're going to get 20% off? So if you go into Macy's, they do it. Victoria's Secret does it, Old Navy does it, Gap does it, right? Everybody does it. Get our credit card. When you sign up for Credit Karma, and I saw some of you were on Equifax and Experian, you will be flooded with emails that says, we have a great deal for you. If you sign up for this card or this card, you should do this, you should do that. So what I tell people, and then I also have clients who receive things in the mail and they go, oh, I got a great offer to refinance my car or to pay down my debt in the mail. Throw those things away, number one. Delete the emails every time you get it. You as a consumer have the ability and the opportunity to control what type of credit you want to apply for, where you want to apply for it, and how is it going to best serve you. Okay, so here's an example of a customer who had 55 new credit inquiries in the last 2 years on their credit report. So inquiries that are on your credit report are only for anything that you applied for in the last 2 years. It counts for 1 year. So it stays on there for 2 years, but if it's older than a year, then it doesn't count in the calculation of your score. So this isn't an area that we really, for services with Kupa'a, that we really focus on, except when we see something like this, then we tell people, okay, you need to stop applying for credit left and right. You're clicking on something that you're applying for credit online. Same thing like when you go buy a car. When you buy a car, they say, well, we have great financing deals. They input your name and your information into the system. You're authorizing them to pull credit. The next thing, you have 10 new inquiries on your report for a potential car loan, but you only chose one of them. So the best thing to do when you're going to get a car loan is to go to your local credit union, ask them what you would qualify for, kind of like a mortgage pre-approval. You're getting a car loan pre-approval, and then you use that to shop. So if they say, "Oh, Rhonda, you qualify for a $25,000 loan. The cheapest interest rate we have is 2.99, but based on your credit, we can qualify you at 3.25." Now you can go shopping, right? I know I can spend up to 25,000. I know my interest is 3.25, and I know what my monthly payment is going to be, and that's within my budget. So that's just some of the tips of what you want to do. So when you check your credit, you want to look at those inquiries. If there are any inquiries that you don't remember authorizing or you don't think is yours, then dispute it and tell them, I never authorized this. Show me proof that I authorized this. If not, get it off my report. Anything on inquiries, Nikki?
Yeah, so actually, for something that only makes up like 10% of your score, I spend a lot of time talking about this as if it were the most important thing, and it is not. VIP does have the ability to do a soft pull. So what that does is give us the information that we need to come up with your debt to income ratios and kind of an idea of what your score might be. But it doesn't drop your score as much as a hard pull, but we need the hard pull to actually proceed with your loan. And if you have good credit, it's not going to affect your score. And if you're shopping for a mortgage, there is some unwritten rule somewhere that I haven't seen, but I've heard that mortgage inquiries within a certain window for, let's just say it's 2 to 4 weeks. If you have a mortgage inquiries from multiple places in a 2 to 4 week window, they're not going to be treated as multiple inquiries. They'll be considered just one inquiry, so they won't have that multiplied effect on your score. I do not believe there is a rule like that for shopping for a car. So what Rhonda said about, the guy saying, well, we'll help you get great financing, and then 10 minutes later you have 10 inquiries. That is true, and I have seen that. It is a terrible, terrible thing to have happen. Do not shop for a car that way. So all of those inquiries at that time, it is going to impact your score. But if you have a good score, not as much. If you have a weak score, it is going to be significantly impacting your score. So just think about those things when having to utilize your credit. If you're ready, then a hard inquiry is going to be necessary. If you're not ready, if they can do a soft pull, then utilize that. And otherwise, just don't worry about the inquiries so much if you are in control and how many you've had.
Yep. So I had a client who whose ex-wife was applying for credit in his name. And so he had, 60 inquiries on his report. And so when he came into service, he said, none of these are mine. So we walked him through the steps and listed for him, what he needed to do. You got to file a police report. Then you get the police report, you turn it into the bureaus, and you tell them which accounts are not inquiries that you authorize, so they can come off. But I'm sharing this with you too, because just be careful and cautious with giving out your personal information. I know we're all taught that, but you just never know when someone else might apply for, credit. I've seen parents apply for credit using their children's social security for themselves without telling the kids, so it doesn't happen often, but this is a time for you to be in control and to be aware of who's using your credit. It should be just you, and that what's reporting on your credit report is accurate. Okay, so this is where you want to screenshot here. So these are the steps to build credit. So if you're someone who wants to boost your score, or you need to increase the credit mix, right, that you have reporting, then these are the things. That guy that was at 400 that went to 700, this is what he did. He enrolled in Self, which is a credit builder account, and there's no credit pool. It costs $9 to enroll. You set it up. They give you the option to put $25 to $150 per month into the savings. Just do the 25. You're not going to get more points by doing 150. So just do the 25. All you're trying to do is show that you have an account, that you're making a payment on, you're responsible, and you're paying it on time. And that is going to help in 3 to 6 months to boost your score. So that's Self, SELF, if you Google Self. Next is Capital One, is the credit builder card that I like to recommend to people, because again, there's no hard pull. When you go onto the Capital One website, you just check mark the boxes that say, I want to build credit and I want a card with no annual fee. Anytime you're applying for a credit card, always try to look for the ones that have no annual fees. There's a lot that are out there. And then we have a list too that we can give to you. So when you apply for that credit card, if they approve for you and give you a credit limit, great. If they say, oh, we can only give you a secured card. So a secured card is you use your own money to put down on the card to be able to spend. So if my son started with a $250 secured card, he had to use his own $250 to put down on the credit card. Then he used his card for gas every month. So he spent it on gas, and then now he's at the point where he has $1,000 limit on his own, because they see that you're responsible, you're using it, you're making the payments, you're on time. So every 6 to 12 months, for any of you that have current credit cards, you always want to ask for a credit limit increase. I was taught, don't get too much credit because then you're going to get into trouble. Well, what you want to do is get to the point where you have $5,000, $10,000, $15,000, $20,000 card limits, because over time, so not in 1 year, like in the next 5 to 7 years, that should be a goal for you, because what you're doing is you're building up your adult report card, which is your credit report, right? You're building up your adult report card to show that you're responsible. And look at this credit card company. They gave me $10,000 and I use it and I make my payments on time, and then they increase my limits. So I'm responsible. So when someone like Nikki, goes, oh, should we give James this mortgage loan? And they see James's credit history has 3 credit cards with $10,000 to $15,000 limit and great, excellent payment history, no late, then yeah, James, you're going to get that mortgage loan, so that's what you want to do, is to be able to slowly over time to build this up. So, but the credit behaviors are important. It doesn't mean you go wild and you spend the limit, live within your means. But some people, all they do, I swear, is they just put Hulu on their credit card, $12. Netflix, $20, some sort of Apple subscription, $12, just put that and show that you're using it. That's what works. The cashback card that I like, but it's totally up to you what you want to use, is Discover Cashback Card, because they have almost the most cashback. It's up to 5% that they give us cashback. So with clients that come in, what we use it for is they'll learn the right credit behaviors with self and with the Capital One. And then with Discover, we'll add it in 6 months to 12 months down the road. And then for their everyday spending, and they pay it 100% off on a monthly basis, then they get $200 cash back. They get $400 cash back. So that money can go towards paying some of your bills. And then that $200 to $400 that was used for bills, now you have money to put towards your down payment savings. So it's all of these creative ways and strategies to use credit and leverage it to your advantage to become that new homeowner. That's what you're trying to do. Then I mentioned being added on to 1 to 2 cards as an authorized user. And lastly, don't be afraid to ask for the credit limit increases. Okay, so what are your credit improvement choices? Once you go check your credit and you're familiar with what's happening with it, and you're like, I think I might need some assistance with this. You have 3 choices. So the first choice is on the far right. You can go to a nonprofit that offers credit counseling. There's some that are located here in Hawaii. There's others that are located on the mainland. They're going to provide that credit education for you, and they're going to provide you some direction to be able to address these derogatory items that might be on your credit report on your own. Next is the DIY program. So the DIY program is, we all want to research and learn how to do some of these things on our own, and we want to figure it out. And so, yeah, you can research it. You can look at different things. There's tons of information that's available on the internet for you to be able to write your own dispute letters, to tackle some of the things that's on your credit report that you want to get improved. When you sign up for Experian, Equifax, or TransUnion, every single one of them are going to say, dispute with us, do it online. So I just want to highlight that when you do it online versus writing a letter, which is what I recommend to keep a paper trail, when you do it online, you're also, when you're signing the terms and conditions before you submit, you're saying that you're waiving your rights for legal representation, and you will pursue any disagreements that you have with Experian, Equifax, or TransUnion through arbitration. So just know that you're waiving your rights. And then also when you're disputing online, they give you the reasons to dispute, right? So when we look at the Done For You program, what Kupa'a provides, and I'm going to share a little bit about our services, is we provide a Done For You program where we take a look at your credit report. If you qualify for the services, then what we do is we write a dispute letter for you in your name every 35 days. So by law, the FECRA law says that if you as a consumer are disputing something on your credit report that you want updated to positive or deleted because it's inaccurate, then they have 30 days to investigate. So you can't write any more letters, during that time frame. So we do unlimited disputes for you. You can stay in the program anywhere from 3 to 12 months. And on a monthly basis, we pull a new credit report, see what the updates are, see what the progress is, and you can meet with us on a monthly basis as well. And then I provide some home buyer readiness assessment and some credit education tips for you. And then if you could benefit from some of my referral network partners, then I'll transfer you to them. So some of them may be, I had a client who's trying to qualify for a HELOC. And what we did was we had them get new insurance agents, and they were able to save $250 on their home insurance as well as their car insurance. And so that $250 of savings then could go to other goals, right? And we have people who've refinanced their car to save $50 to $200 a month on their car payment. So again, same thing. The money that you save through our referral partners, you can go towards down payment savings. So overall, when you look at if you have a 599 score and you're trying to get a car loan, you're going to pay over $10,000 of interest more than someone with a 730 score. If you have a 599 score for a home loan versus someone with 730 score, you're going to pay almost $200,000 more in interest. So the services for Kupa'a, I put on the right, it costs almost $1,000 for 6 months of service. Okay, and so $1,000 to save $10,000, $1,000 to save $200,000. That's the way you kind of look at it if you fall in that category of needing services. So let's look at some other client examples. So this is the client that came in with the 599 score, and in 90 days, they increased their score by 71 points. So this is the one that barely had any credit. They were recommended to follow all of the credit building tips, but essentially they had a lot of student loan accounts. So that's the 4 boxes that you see here: late payment, charge-offs. They never contacted the student loan people. So we took action, contacted all the student loan accounts, got them all updated, got them all put on forbearance, right? With them, got them all updated to positive and current. And in this case, they added a secured credit card, they added the self account, and they were able to boost their score. So this next one is someone who had late payments during COVID for a HELOC, late payments for COVID for a personal line of credit. So all of these yellow boxes that you're seeing, this 2-year payment history, that's all late, reporting to American Savings Bank. This client tried on their own. They walked into American Savings Bank. They called every person imaginable at American Savings Bank to get it updated. They couldn't, so they came to Kupa'a to see if we could help. This was the only thing that was on their credit report. So normally we wouldn't, they don't really need that assistance, but they didn't qualify. Their HELOC loan was denied because of this, because of these late payments. And so we used consumer law, we wrote the letters, and 90 days later, and it was inaccurate. When I went back and looked through all the statements, it was wrong. It was reporting wrong. So 90 days later, got all of the late payments updated to positive. So this client was denied a home loan. Pre-qualification letter came in, and this was a policeman who, in his heyday had all kind of credit cards, never make all the payments on time, carried some of the balances, didn't really look at his mail, and so forth. But anyway, and he had high credit utilization. So this one is 95% and 114%. But he was a great saver. Like he had money in the bank for his down payment. So he used some of that savings to pay off all of the credit cards. So the credit utilization within 30 days came down to 0%. Then he had 4 charge-off and collection accounts. So we negotiated for him to pay 50% of the balance of what was owed on these accounts in exchange for them to delete it off the credit report. 3 of the 4 creditors agreed to delete it. And one of them didn't agree, but it was still a paid off charge collection account. So this is his results 41 days later. So this is a client that was like hyper vigilant. I want to get this. I got to get my loan. I got to buy, that land. He was buying land. So we got 12 items deleted and his score went up 122, 112, and 176. So the possibilities are there and it can happen. And I hope this provides inspiration and motivation for each of you to just take action and take the step to start. So my message to you today is start now. Don't wait, don't go, oh, the market, interest rates are high, or I have too many late payments, or it's going to take a long time. Just start and you'll be surprised month by month what happens and the improvements that you make. And we have some clients 1-2 years later, they're at the point where they're ready. So it's your timeline. So if you want to get a free credit audit, you go to the Kupa'a Consulting website, you click on Get Free Audit, follow the steps. I'll meet with you on like this. We'll go over it, see if you qualify, give you some tips that you can take on your own. And, Niki and I are here to help you. We get a lot of joy out of seeing people like you qualify for a home loan and get into one. And we're here to be part of your credit hui to assist you along the way. So here's our contact information. You can screenshot this. You can reach out to either one of us. And at this point, this is pretty much the end of my piece of sharing, and we have some time for you to ask questions. So what questions do you have? And how can we help you?
Anybody with something they had experienced, they didn't know how to deal with it. Now you have an idea how to deal with it?
I do have a question. Like, let's say, because I know you talked about the authorized user. Like, let's say somebody's on as an authorized user, everything's going well, but then the user that you're under starts kind of getting shaky. What do you just have yourself taken off? How does that work?
Yeah, take yourself off.
Yes.
Take
right
yourself
away.
off. Yeah, just take it. So you can call if you know who the person is, that's the original, because you're going to have to validate that this account belongs to, Niki Hubbard. I'm an authorized user. I don't want to be on it anymore. Take me off. So you can call to be able to do that. If you have a good relationship with the person, then you can also ask them, can you call and get me off?
All right, we got one in the chat. How often should you be pulling to check your credit?
So when you're buying a home, I would get in the habit of checking monthly. So that's why I say get the subscription, because then you want to see what the progress is. It depends on what's on your account, so get into the habit of checking everything. Go ahead, Niki.
So my advice is usually at least once a quarter. If you use a monitoring service and it's free, that's great. Monitor it that way. If you don't, and you want to use the annualcreditreport.com, that'll allow you to do a hard pull from each bureau once per bureau per year. So there's 3 bureaus. So every 4 months you go do Experian in the first quarter of the year, and then do TransUnion second quarter of the year, and then Equifax third quarter of the year, and you could repeat that. But that came about before there were all of these extra monitoring services from your credit cards and Credit Karma and those companies. So Um, yeah, it's okay to look at it often, especially if you're working on it. If you have it where you're set in your system and you know what's being charged where, and you have it where you're not doing a lot of inquiries and you're not going to grab a lot of credit, then really what you're looking for is just to make sure there isn't any fraud going on, right? So that you're aware no inquiries that you didn't authorize went on there, no accounts that you didn't authorize went on there. So you don't have to, hopefully you don't have to do it as often, but definitely still look at it.
Yeah, thank you. I forgot to mention annualcreditreport.com. So you can pull your own credit free. You won't have a score with annualcreditreport.com, but it'll give you all the details of the accounts, which is what's super important.
Yeah, you'll be able to see your utilization and your history as well as inquiries.
Yeah, so what else? What kind of scares you? What was surprising for you today? What makes you nervous?
We have a quiet group. I will tell you personal experience. So, um, my husband had horrible credit when we were young, like, 20 something year olds. And that's very common because you're not educated in any way at that age by anyone, usually, about credit. So, um, luckily, I had good credit. So I added him as an authorized user to my credit card at that time. I think I had like $1,000 limit on my one credit card that I had as a, college student. And his we had a lot of work to do to clean things up and got that stuff all cleaned up. And then now it's a competition whose credit score is better, and he somehow has a better credit score than me regularly, although I got him his score. But having the authorized user history that's positive helped him, because he wasn't able to get any other credit at first, and he needed to have some positive history to offset that negative history while that negative history was being worked on. So the authorized user is a big help. You have to be real careful about who it is, though. That's my story.
Yeah, so Ashley asked, does it matter if we check our credit score through a credit card app, or shall we use those that were listed in the presentation? If you're not in the habit of checking credit, just start with any one. So if the credit card app is the one that helps you to get in a rhythm of checking and understanding, and if you're looking, as long as you can see the account details, that's what you want to see, is the account details to see if anything's reporting late, collection, charge off, those types of things. If it doesn't provide you with that, then go look for another one. So let me pull up some of the other ones. I'll do, let me see.
So Rhonda's putting some links in the chat that we're talking about.
Yeah.
If you want to check the chat for any of those links.
So smart credit is what I use with clients, and then
That just reminded me one more important thing before anybody jumps off, because I know we're almost at an hour. So there are different credit scoring models. Rhonda, correct me if I use the wrong terminology, but when we check your credit for our mortgage, we're using one model, and a lot of the consumer credit checks that you can access from your credit card or my FICO is using a different model. So sometimes you're going to see on your monitoring, my score says 680, I'm good to go, I'm going to go get a USDA loan. You go to the loan officer, you have their credit, they pull the credit, and it's 666, and you're like, what? Why is it lower? But it's because it's a different model that's used. So a lot of times your loan officers already going to know that there's a difference. So if you tell them what you see your credit score is and what you're using, they'll be able to know and take, the difference with a grain of salt. It wasn't because you did something bad or anything. It's just that it's a different scoring model that's used for those those different reporting tools. So we're a lot of the loan qualifications as in a 20-point increments. So if you get between 620 and 640, that's one tier, and then 640 to 660, you guys get it. So it's okay. You know, we got a 20%, 20-point bracket. We want to just, which one are we in? So it's a little rough if you get below the bracket you thought you were in, but your loan officer will usually have that in mind and be able to make sure you're in the bracket you're going to be in is still a qualifiable score. So don't get really upset if it's not exactly what you saw. It's that's not unusual.
Yeah, so we encourage each of you, if you haven't started, to start the process, start the journey, and you do it by, you know, meeting with someone like Niki to find out, okay, what do I qualify for? And then she says, okay, you know, either you do or you don't. And if you do, you would qualify for more if you improve X, Y, and Z on your credit report. Now you know, and now you have some of the tools and the information that was shared today, and you can lay out a plan. And that's what you should do, is just lay out the plan and start taking those steps. It's your timeline, it's your journey, and we're here to help you.
Absolutely. Yes. We are definitely, when we're looking at mortgage qualification, if you're not in a position to be approved yet, we're not denied, we're just mortgage delayed. So
Yeah.
Our goal today is to get you started on the credit part first, so there's less chance that your mortgage delayed.
Yeah. So, any other
Thank you all.
questions?
Yes. Thank you all for joining
Okay.
us. You have our contact information. Please reach out if you have more questions in the future. Anytime, we're happy to be here for you. And we really appreciate you joining us tonight.
Yeah, thank you for joining us, and good luck to everyone.